now in Calgary, two people could buy a home on the exact same day, and one of them could be making a great decision, while the other is quietly stepping into a market that's already sliding. Same city, same month, completely different outcomes. Because Calgary is not one housing market. It is two markets running at the exact same time, and the gap between them right now is the widest I've seen in years. Which means if you are buying or selling this spring, where you sit inside that split could cost you tens of thousands of dollars. And the headlines? They are not telling you which side of that line you're on. Here's something I want you to remember. No matter when you watch this video, because it is true whether we are in a buyer's market, a seller's market, or anywhere in between, the people who make good decisions in Calgary real estate are the ones who understand that the headline number you hear, that one benchmark price, that 1 months of supply figure, is the average of a city running two completely different markets simultaneously. The people who get hurt are the ones who treat it as one. Before I show you exactly where that line is drawn in the February data, I want to walk you through 3 economic reports that dropped recently, because you need to understand what kind of ground this spring market is standing on before the CREB numbers make complete sense. Let me start with GDP, because this is where the spin is the thickest. The headline for December 2025 was GDP rose 0.2%. Sounds fine. But here's what that headline did not tell you. The fourth quarter of 2025 actually contracted. The economy shrank in Q4 after growing in Q3, and the advanced estimate for January 2026 is essentially flat. 0. For the full year 2025, Canada grew 1.7%. That is the slowest annual growth since the COVID crash in 2020. 5 consecutive years of expansion, yes, but each year getting a little weaker than the last. And the December bounce the media celebrated, manufacturing came back after contracting in both October and November. That's not really a sign of strength. It's more of a bounce after a couple weak months, not a trend. Now here's the part that connects directly to you as a buyer or seller. Within the GDP data, there is a line item that tracks actual real estate transaction activity across the country. And nationally, that number is contracted 2.1% in 2025, tied directly to fewer homes changing hands coast to coast. Canadians are buying and selling less. That is not just here in Calgary. That is a whole country pulling back, and January's advance estimate shows that same category retreating again. The most current signal we have on real estate activity nationally is pointing in the wrong direction heading into spring, and that matters because it tells you the hesitation you might be feeling is not unique to you. It is showing up in the data. Manufacturing is the other story buried in this data. 3 consecutive annual declines. The GDP report explicitly names U.S. import tariffs on Canadian goods as a primary driver. Wood products, metals, fabricated metal. This is not a one-quarter blip. This is a structural shift with a clear external cause, and it is not reversing until the trade picture changes. So that is the GDP story. Growth, but barely, and decelerating. Now, layer in the jobs data and the picture gets even more clear. I want to be frank about something here, because I have talked about the labor force survey before and how headline unemployment numbers can look rosier than reality when discouraged workers simply stop counting themselves as job seekers. The report I am referencing now is different. The survey of employment, payrolls, and hours counts actual CRA payroll records. Real employers, real paychecks. You cannot massage this one. In December 2025, payroll employment fell 35,400 nationally, and this is not a 1-month event. For all of 2025, manufacturing specifically shed 40,600 payroll jobs, a 2.6% decline in 1 year, hitting transportation equipment, food manufacturing, and chemicals hardest. And the signal I watch even more closely than layoffs is hours worked. Hours are being cut before headcount follows. That is how it typically unfolds. Trim the hours first and then reduce staff. When hours are declining, job losses usually come next. Wages are the other piece that connects directly to housing. Year over year in Alberta, wage growth is essentially flat at 0.5%. With inflation still above target in many categories, that means real purchasing power is eroding. People qualify for less than they did 18 months ago, and they feel less confident stretching on a big purchase. Now, Alberta is still outperforming the country. While Ontario lost 67,000 jobs in January, Alberta was adding. Calgary's employment picture remains one of the stronger stories nationally. But the tide coming in from the broader economy does eventually reach our shore. And these numbers tell you the tide is coming in. Pull these reports together, and here is the honest picture heading into spring. The economy grew in 2025, but at its weakest pace in 5 years. The sectors that grew were government spending, bank profits, and rent. The sectors that contracted were manufacturing, trade, and real estate transactions. Wages are slowing, hours are being cut, payroll jobs are disappearing in the private sector, and the January 2026 advance estimate is flat. For buyers, this means the pool of confident, financially secure people who can comfortably stretch on a purchase is thinner than it was. Not gone, just thinner. And that matters more in some segments of the market than others, which brings us exactly back to the two market story I opened with. For sellers, it means buyers are getting more cautious, not because of sentiment, but because their actual financial footing is shakier. Pricing this spring has to reflect that reality. Now, let's look at what February actually showed us. Total sales in February came in at 1,526. That is down 11.2% compared to February of last year. On the surface, that sounds like a slow market across the board, but this is exactly what I mean about the headline hiding the detail that actually matters. The sales decline was almost entirely driven by apartments, down 27% year over year, and row homes down 15%. Detached sales, well, they're down just 4%, semi-detached up 7%. So when someone tells you Calgary sales are down 11%, ask them which Calgary are they talking about, because for detached and semi-detached buyers and sellers, the February picture looks almost completely different from the headline. Those two segments are holding. The high density market is the one doing the pulling. Year to date through February, total sales sit at 2,760, down about 13% from the same period last year. New listings came in at 2,766 for the month, down 2.3% from last February. Sellers are not flooding the market. The inventory buildup we are watching is not a wave of panicked listings hitting all at once. It is homes sitting longer because the buyer pool in certain segments is thinner. That is a different and more durable kind of pressure, and it explains why the problem is not resolving itself quickly. The sales to new listing ratio citywide sits at 55%, which is technically balanced territory, but split it out and you see exactly what I mean. Detached is at 58%, semi-detached at 69%, row at 55%, and apartments at 46%. A 23 percentage point gap between the tightest and softest segments. Those are not variations in the same market. Those are two completely different markets reporting under the same headline story. And that brings us to inventory, which is really where the two market story lives. Total inventory at the end of February was 4,822 units, up 16.3% year over year. Condominiums and row homes now represent more than half of all inventory in the city. That one fact explains most of what you need to know about where the supply pressure is concentrated and why the apartment market is behaving so differently from detached. The construction story ties directly into this. Krebs' own chief economist noted that Calgary had record apartment construction starts last year, with nearly 18,000 units currently under construction. A large share are targeted for the rental market, but rental supply still competes with ownership condos for the same tenant and buyer pool. More supply arriving into weakening demand is why this inventory number keeps climbing, and it is not a short-term problem. Now, here is the number that makes all of this real. Months of supply tells you directly how long it would take at the current pace of sales to clear all existing inventory. And this is where the two-market split becomes impossible to ignore. Overall, citywide, 3.16 months, up 30.9% from last year's 2.41 months. Under 3 months historically favors sellers. Above 4 favors buyers. Between 3 and 4 is your balanced zone. At 3.16, overall, the city looks balanced, but break it out, detached, 2.64 months, so like tilting towards the seller's market. Semi-detached, 2.37 months, the tightest segment in the entire city right now. Row homes are at 3.29 months, so balanced, leaning, slightly towards buyers. Apartments, 4.58 months. Firmly in buyer's market territory. And by district, the Northeast apartment market is sitting at nearly 11 months of supply. Nearly 11. That is a deeply oversupplied market, and prices are responding accordingly. And here is the thing about those numbers in real time. From January to February, months of supply actually tightened citywide. Sales to new listings jumped 44% to 55% in a single month. Prices in detached, semi-detached, and row all moved up month over month, which is typical as spring approaches, but apartment prices went the other direction, down again, even with seasonal momentum behind them. Every other segment picked up ground. Condos gave it back. This is not a year-over-year trend. And I want to say this because I am seeing it myself out there right now. It feels busier. More conversations, more showings, more people making moves, and the data supports that. Sales jumped nearly 300 units from January to February alone. Days on market dropped from 53 to 42 in a single month. The year-over-year headline looks slow because last February was strong, but the momentum building right now is real. And here is the number that makes that real in a way that surprises people. In February, 23% of homes sold at or over list price. We are back to seeing multiple offers, thousands of dollars over asking in certain areas and certain property types. So while the headline is telling you sales are down 11% and the market is cooling, there are buyers out there right now losing out in competition. Literally 2 nights ago for the sweetest couple that I'm working with right now. That is not a cooling market story. That is a two-market story. And which side of it you're on depends entirely on what you are buying and where. And price is where we see all of that play out. Total residential benchmark price for February was $560,500, down 4.4% compared to February of last year. Month-over-month prices actually moved up about 1% from January. Seasonal patterns tend to push prices slightly higher early in the year, and we are seeing that in the lower density segments. But the year-over-year decline is real, and it is not evenly distributed. Detached homes are at 734,300, down 3.2% year over year. Semi-detached are at 682,200, down just 0.4% year over year. The tightest supply in the city is doing its job protecting prices here. Row homes are at 423,600, down 5% year over year. Apartments are at 298,600, down 9.3% year over year. Nearly a 10% price decline in 12 months. That is not a rounding error, okay? That is a meaningful shift that every condo owner and every condo buyer needs to take seriously. If you bought a condo in Calgary in early 2024, at peak pricing, and you're thinking about selling right now, that is a conversation worth having carefully. And honestly, before you make any moves, I'll be straightforward. I would recommend staying put versus taking a loss right now. By district, the West is the only area in the city showing a year-over-year price gain, up 0.1% to 706,900. The Northeast has taken the hardest hit across all property types, down 8.6% year over year. City Center detached is holding near flat at 967,800, up 0.31% year over year. Inner city low density product still has some real demand sitting behind it. So now connect the economic picture to the local data and the full story comes into focus. The broader economy is softening. Wages are barely growing. Payroll jobs are being shed in the private sector. GDP is at its slowest pace in 5 years. None of that crashes a market on its own, but it does thin the buyer pool and make people more cautious about large financial decisions. That caution shows up first and hardest in the segments with the most supply and the least urgency, which right now is apartments and outer suburban row homes. If you're a seller with a detached or semi-detached home priced correctly in an established inner city community, you are still in a workable market. Days on market for detached have risen from 28 to 35 year over year, which gives buyers a slightly longer window, but quality product priced right is not sitting. If you are selling an apartment, you need to be honest about where your pricing has to land relative to a market where buyers have real options. Months of supply is pushing towards 5 and prices are down nearly 10% year over year. That does not mean your condo cannot sell. It means the price conversation has to be grounded in what the data says today, not what your neighbor sold for in 2023. If you're a buyer and condos fit your budget, and your life, the apartment segment is the one place in Calgary right now where you genuinely have room to negotiate. Sellers in that segment are sitting longer, prices have come down significantly, and the supply picture is not improving quickly. You are in a better position than you were 18 months ago. Just make sure the numbers work for your situation at today's rates, not where you hope they will be 2 years from now. If you have any questions, you can book a call with me in the link below. If you got any value from this video, please give it a like and subscribe if you want to see more from me. Thank you so much for watching. I really appreciate it, and I'll see you soon.